A key task that you're going to get asked to do at some point, whether it's on your SAC or the exam, is to recreate ledgers, in particular the inventory ledger. And you could be asked to do that just from the inventory card. So what are we talking about? Well, we've got an inventory ledger, okay, and we say there's debits and credits, and that's an asset. And the debits in this case would go on the left hand. So sorry, the debits are always on the left hand side, but for an inventory account, it's going to go up when there's a debit, and it's going to go down when there's a credit. You also need to know what are the transactions that would make inventory go up and down. So we would have the cash purchases and credit purchases would increase inventory, and the opposite of that would decrease it. So the opposite of buying inventory for cash is selling it for cash, and the opposite of buying it for credit is selling it for credit. Another thing that could make inventory go up is sales returns. A customer brings something back, and what can make it go down is the opposite of that, a purchase return. Inventory could go up if we do an inventory count and we end up with an inventory gain. And the opposite would be an inventory loss, and that would make inventory go down. And then that's it for all the things that could make it go up, but we have a few more that could make it go down when the owner takes drawings of inventory or inventory is used for advertising. And then we've also got something called an inventory write-down, which we haven't dealt with yet. We'll learn about that soon. So that's everything that could affect inventory and go in the inventory ledger. So we definitely want to turn that into a cue card and say, have that in front of us for the rest of the year about what could make inventory go up and what could make it go down. So we need to now match that up to the inventory card. So here's our inventory card. So these are the ones that make it go up. So they must be in the in column because in means more inventory. So inventory would go up. And these ones here that make it go down, they would be in the out column. So we should expect to see these things here in the in column and these things here in the out column. Now, another thing we did is we said, how can we create the inventory ledger from the inventory card? Well, we just take ins and outs and document numbers. So we have a previous video about how to interpret the inventory card where we looked at the different types of document numbers, whether it's in the in column or the out column, and what that must mean. So we said, here's all the transactions that could occur. Here's the document type, and here's the column. And that's what we're going to do for each transaction. That will help us determine whether it's making inventory go up or down and what it was for. So let's start with this one. We've got an opening balance. That's not a transaction as such, but what would that look like in my inventory ledger? So what we're saying is at the start of the month, inventory had a balance of $300. Now, assets have debit balances, so that would go here, and we'd write 1st of April, balance, and we'd write 300. All right, what about this one? 6th of April, check, in column. So what do we got here? In column. Now, the only thing in the in column that could have a check would be a cash purchase of inventory. So in column would mean inventory would go up. Now it's on the 6th of April, so we'd write 6th of April. Now in the ledger, we wouldn't write the document number here. In the inventory card, we would. We're not going to write check 91 there. We're going to write the name of the ledger on the other side. So on the other side of this would be the cash ledger for $900. And that's making inventory go up, so that's why it's a debit. The next line of that inventory card was 11th of April, memo B4, out column. That's a tricky one. Memo, out column. Well, it's got to be one of these four things. We don't know what inventory write-down is yet, so we'll deal with that later. Now, an inventory loss, usually an inventory count is done on the last day of the period. Not always technically true, but probably will be in our subject. So that probably rules out that one. So now we're down to this is either drawings or advertising. So either of those answers would be acceptable. If this was given to you, there'd actually be two right answers for this. They would say you could write it's making inventory go down, so we'd write the 11th of April. If you write drawings or advertising and the amount, 120, then you'd have that correct. This one, 14th of April, invoice out column. What do we got? Out column invoice, that has to be credit sale of inventory here. So that's a credit sale. So when we're selling inventory, we got less of it. That's why it's in the out column. So that's going to have to be a credit because it's going to make inventory go down. So I'll do 14th of April, 210. Why did I write 210? It says 180 and 30. That's because the inventory card records each unit, like each cost unit, right? The $10 and the $15 ones. But really, the only number we need here is the total. So 180 and 30 is 210. Now, just one thing. I've written cost of sales there, but I said it was a credit sale. So why didn't I write accounts receivable there? And this is probably the most common mistake you're going to make. Why does that say cost of sales and not accounts receivable? Well, let's go back here. Let's look at how would we have recorded this sale? when we actually made it, right? Well, we don't know the selling price, so I'm just going to say the selling price here was 500 plus some GST. So we would have done debit, accounts receivable, 550, matches up with credit to sales of 500, credit to GST clearing of 50. That's actually not the part we're doing in this inventory card here. We're doing the next bit, which is what we call the cost of sale. Cost of sale was 210, that was 180 plus 30. And that meant inventory went down 210. So what we're actually doing is this entry here. We're going to inventory and doing a credit here. Where would I find the matching debit? I'd actually find it in cost of sales there. So that is why I'm going to write cost of sales 210 there. So don't get sucking into that one and writing accounts receivable there. I've got it 15th of April, credit note in column. So credit notes mean some sort of return. So it's either a customer returning a sale or my business returning a purchase to the supplier. That's in the in column, so this one's got to be a sales return. Another really tricky one. Sales return means inventory is coming back in, so that's going to be a debit. It's going to increase inventory, 15th of April. And again, I'm just writing the total, so 20 and 30 is 50. But again, why don't I reference accounts receivable? Why am I referencing cost of sales? Well, for the exact same reason as before, because when the sales return comes back in, we'd actually do this. So let's say the sales return, we don't know this, but I just made up a number. It was $100, so that would be a debit to sales returns. A debit to GST clearing of 10, and accounts receivable would go down 110. We're not dealing with that. We're dealing with this bit. We're saying inventory came back in at 50, and we undo the cost of sale. So that's from a few topics ago. So if you're confused about how to deal with a sales return, go back to chapter 6 and watch the videos. But here, we've got inventory going up 50. That's the entry we're doing. So if we're doing that entry, well, the opposite or the matching entry is in a ledger here called cost of sales, and that is why we wrote cost of sales 50 there. Invoice in the in column. Invoice in column. What could that be? The only thing that could be in the here is a credit purchase of inventory. So that means we bought something on credit. So that means we owe money. So that is accounts payable. So we have more inventory. So it's in the in column, $240. So that'll go there, 18th of April, 240. And our reference here would be accounts payable because it's an invoice. So that was a purchase on credit. We've got 19th of April, details of a credit note in the out column for $60. Credit note is either a sales return or a purchase return. This one's in the out column, so it's got to be a purchase return. So we are returning inventory back to our supplier. That is called an accounts payable. So this one is going to do the opposite of this one here. This one here, we bought inventory from accounts payable. Here, we're sending it back to accounts payable, and we're doing $60 there. So remember also no GST for any of these items in the inventory ledger. That would go in the GST ledger. We're not doing that. We did that in chapter 4, so we're not talking about that now. Next one, 27th of April, receipt out column for 20 and 8/10, so that's 830. Out column receipt. The only thing that could be, if we look in the out column, the only thing for a receipt would be a cash sale. So that's a cash sale. So we've got less inventory. That's going to go here. 27th of April, cost of sales 830, and sorry, just to go back, just like with a credit sale, we just write cost of sales here. We're not writing cash. The cash part would be for the revenue part. I'm dealing with the expense part called cost of sales. And the 20 and 810 equals 830. 30th of April, so we get to the end of the month, there's a memo, so that probably tells you that some sort of inventory account's been done. We've either got an inventory gain or an inventory loss. So in the memo in the out column where we said we're not doing inventory write-downs, this one here, technically this could be drawings or inventory used for advertising. The question would probably rule it out and say it's neither of those. So you would be expected to know that looking at that last day of the month, out column memo, that's probably going to be an inventory loss. So we have lost 90 and 12. We've lost $102 worth of inventory. So we do here 30th of April, inventory loss, $102. And that is every possible transaction that we know how to do it for the moment. So what would we be asked to do now? Well, I guess we'd be asked to balance it. So we got all our transactions here. We add up the bigger side, which in this case, if we add up the debits, they'll be bigger. And we write that number there. We leave a line and we say the total of these numbers here is 1490. Write that total on the same side. And now we're going to subtract away from 1490, 120, 210, 60, 830, and 102, and we will get a total of 168. So we'll do the 30th of April, balance 168. But remember, we've got to carry that balance down to next month because inventory is an asset. It should have a debit balance. So on the very first day of next month, the 1st of May, the balance will be debit $168. But doesn't that number look really familiar? The final balance, that's a weird number one. It's not a nice round number. Where have we seen that? Well, if we actually look at this inventory card here, right, they got a lot going on, but if we just go all the way to the end, we said at the end of the month we should have 14 units at $12. That is also $168. So what are we saying here? Well, I guess we're saying if we get the balance right in all our, to get our balance right in our inventory ledger, just means it's going to be the total of all the final balances in the inventory cards. So if this business just had one type of inventory and this was the only inventory they had, this total here should match that total there. But in reality, I guess what we're saying is, we're doing the balance sheet, right? How can we ensure the balance sheet is correct? Well, we've got inventory cards, right? This was just one, and it had a balance of 168. That matched the inventory ledger there. So in the balance sheet, we'd go to inventory and report it as a current asset of 168. And that's how we make sure everything is correct. The balance in the balance sheet, which is what the public sees, matches the balance in the ledger, and that matches the balance in the inventory cards. And that was $168 across all three. And what we've got there is that figure was calculated using the perpetual inventory system. That means as soon as something happened, we recorded it. So it's 100% up to date. I guess that fulfills our qualitative characteristic of timeliness. This $168 figure also includes every single transaction. Every possible transaction we could have done except for inventory write-down was done. So that means it's 100% correct, this $168 figure. And that means we fulfilled the qualitative characteristic of faithful representation. And lastly, we can use this $168 figure to check the amounts in the inventory ledger and the balance sheet. So this figure here in the balance sheet now is very, very verifiable. We can prove that figure is true by matching it to the ledger and then matching the ledger to the inventory card. So that fulfills the qualitative characteristic of verifiability. Well, we just want to notice just one last little thing and go, well, really, we don't just have one inventory card, we have a whole bunch of them. So there will be an inventory card for every different type of inventory a business has. So let's say these were all of them. So we can see this one here for 168, that's the one we did, but they'll probably have inventory cards for other things. So this one has a balance of 2,000, this one 5,400, 600, 200, and so on. If we add all that up, the total of all of those, which is 37,200, that would go in the inventory ledger. And then when we do our balance sheet, we would actually put under current assets, inventory has a final balance of 37,200. So really just note that the figure shown in the balance sheet and the ledger is really the total of all of the inventory cards and not just one.